Good morning. You're welcome. This is your host, Ian Adegborowa from Price Action Traders Forum. It's just what I'm going to show you is what has been the talking of the recent in the financial market. Trust me, if you enjoy, if you finish watching this, I'm very sure your trading concept, your knowledge will never be the same. Your knowledge will never be the same. Yeah, because the truth is that whether you like it or not, information is vital in the business of trading. Information is vital. Yeah, this could be just a kind of intersection point coming to this platform. Be a kind of intersection point for you that will give you a turning point in your trading system. Yeah. Once again, I'm your host. Yana Deborah, the Chief Technical Analyst of Forex Action Traders on Telegram. For about 15 years now. Yeah, trading has been my part of life, being a part of me entirely. Yeah, recently I came to AMD, been through ups and downs, losing trades here and there. But I thank God for the recent, from years back, recent discovery about the AMD and some price action patterns that worked in the market. Yeah. So just sit tight and enjoy the process. Yeah. So now coming to AMD, a lot of you want to ask why this pattern works to the precision of at least minimum of 97%. You may want to ask why it works. What makes it so thick that I could not, but that you can't afford to do without, without AMD. You can't afford to miss. Yeah. So let me, according to one of my most respected legends in this market, which Richard Wakoff himself. I respect the man so much. It's late now, but the trading philosophy, the trading plan still works. Because of what? Because it is all about human behavior. Patterns works now and then, recurring from years to year. Yeah. If truth be told, the financial market is entirely all about price manipulation by the institutions, whether you like it or not. Be it the stock market, the bond, the commodity market, the cryptos, Bitcoin, Ethereum, and the rest of them, and then forex market or gold or whatever market, measure any market, even the systematic indices, the stock indices and the stock indices on binary options, measure any market, Whether you like it or not, price manipulation is what moves the market up and down. Price manipulation. By who? Who manipulate this market? The institutions. Who are the institutions? The big players, the big market participants. They move the price up and down. How do they move the price up and down? So that you can move with them. Whether you like it or not, they own the market. According to Wyckoff, he proposed a heuristic device to help understand price movement in individual stock and the market as a whole, which he dubbed as the composite man. So Wyckoff called these market makers, the market maker, as the composite man. Yeah, they are composites. So all the fluctuations in the market and in all the various stocks should be studied as if they were the result of one man's operations. That is what he meant by being a composite man. Let us call him the composite man, who will in theory sit behind the skins and manipulate the stocks to your disadvantage. He manipulates up and down, the highs and the lows, where the stops are being placed. That is their business. They don't have any other business than to hunt the stops placed above the highs and below the lows of the market. If you don't understand the game as he plays it, as the composite man, the market maker plays it, and to your great profits, if you do understand it. So that means understanding is the key, like the Bible says. Understanding is wisdom is the principal thing. But with wisdom, get understanding. Yeah, the book of Proverbs. So that is the quote from Richard Wyckoff in his Stock Market Science and Technique, the publication he wrote before he died. Wyckoff advised retail traders to try to play the market game as the composite man played it. You must play with them. You can't beat them. You have to play along with them. Yeah. So thank God that we've come to the discovery of this formula. Yeah. So that you don't lose anymore, because you don't have the capital these guys are playing in the market. You can imagine like the JP Morgan Chase or Federal Reserve Banks of US play with $20 billion at a go. So what is your $500 got to do? Volume pushes the market up and down. Volume dictates the market. Yes. Yeah. So you got to play along with them. In fact, he even claimed that it doesn't matter if the market moves are real or artificial. That is the result of actual buying and selling by the public and bona fide investor, or artificial buying and selling by large operators. Whichever way you move it, they move it against you. Yeah, you the retail trader, so you don't have anything. So what is AMD? AMD is simply an accumulation. A represents the alphabet. A represents the accumulation, while the M represents the manipulation of prices. Then the D represents distribution of profits. Yeah. So the market makers accumulate the market. Accumulate their assets during the price range. So they look into when the price is ranging to accumulate the highs and the lows of the market, and they distribute. That means price ranges and expand. That is what causes this thing. That is how the price it circles out, and then yeah, it accumulates price ranges. Up and down, expand. So this becomes the ranges of the market accumulation. Then This is the expansion, which is the distribution. It expands upward, and then after expansion, it starts raging again. So this is exactly what happens in the market. If you go to your chart, this is what you see up and down, right? This is what you see up and down in the market, right? Yeah. So the accumulation of this high and low happens through price ranges, while the manipulation happens after they must have they must have gathered enough this thing, you know, manipulate the up and down, the high and the lows of the market, until the stops you place above the highs and below the lows. Then distribution of profits. They take the market in the opposite side of the manipulation. In essence, they fade the market. When you are trying to, they try to push the market out of the high, they induce a lot of people into the buying of that market. And once they see that, okay, the people has come into the market to buy, they fade the market. They fade the market against them. If they try to push it below the low, you know, inducing the people that into selling into the market. And once they discover the crowd has, you know, been induced into big selling, they move the market in opposite upside. Right? So you have to be very careful the way you trade in the market, in this market. Very, very careful and be knowledgeable about how they move the prices of markets up and down. How they move it up and down. How they move it up and down. Yeah. So every day by day. So this is what happens. Accumulation is it happens due to the price ranges. Can imagine, for example, here, the lows here. What they do is they hunt all the lows, all the levels of people that are they believe that, okay, when price has got to the support, it bounces up and you buy, place your stops below the support level. That is the general belief. That is conventional trading method. Buy at support area, place your stops below the support. Sell at resistance area, place your stops above resistance. Right? So that is the general method. That is the conventional way of trading. Fine, it's a good method. But do you know that whether you like it or not, you are inviting the market makers to come and take the market from you, instead of you buying at a lower price and selling at a higher price. You are doing the opposite. Yeah. So you are inviting the market maker to come and take this market from you in the opposite way. So this is how it goes. This is how it goes. This is how it goes. When you place your, for example, when you place your Euro USD, you buy Euro USD, you want to place a buy order for Euro USD, right? Buy order, right? Of Euro USD. Euro USD. For example, if this is the price, If this is the price, the recent price you bought from, right? So you have, that means your stops will be below here. Be below here. You play your stop below here. Do you know that when you immediately you place your buy order, at the same time you are selling to your broker. When you buy this order, you are selling to your broker. Buy at. You have been giving these quotes, for example, you have been giving these quotes. Buy Euro USD at this price. Then yeah, this is the quote you'll be giving. This is a quote circle by the left, while you have the buy quote by the right. So that means if you are buying from the broker, you buy at 1.3060 euro. Then if you are selling to him, you sell at 1.3050 euro. Yeah, so the difference is now, because it's now 10 pips. That is the spread, which is what the broker gets from that transaction. So once you place, immediately you place this order, you buy from broker at 1.3060. At the same time, you are selling at this rate, 30.50. You are selling lower to him at a lower price, right? So that means the stops you buy at this level. You buy at this level. You can imagine you bought at this level, and your stop loss prevention is okay. Your stop loss is maybe you place a stop loss of 10 pips below 360, or 20 pips or 30 pips below that, right? That's right. So if you place your 20 pips below that, that would be 20 minus 1.3060. That would be 1.3040. You place your stop loss below here. Now, let me do it like this so that you understand. Okay, so I really want you to understand this. Why you cannot sue the market makers for doing so, what they are doing, because you invite them in. Yeah. So your stop loss is placed below you at 30.40, right? Now, what does it interpret to a broker automatically is this: I'm buying at 30.60 from you. The broker himself is a market maker. It's part of the market maker. You are buying from him. He's selling to you at 30.60, right? You are buying from him at 30.60. Now, if you are selling back to him, it will take it from him. Will take it from you at what? At 30.50. That is the price he gave to you at 30.50, right? Now, you buy, at the same time you are selling back. You understand the point now? You give the broker your USD to get Euro USD, a change of 2 pairs. So that means the stop loss you place below your buy order automatically is transmitted. It transmitted to stop loss. That becomes a set stop order. This becomes a set stop order. It becomes a set stop order below here, below your buy order. Okay, I am buying at 30.60. If the market comes down against me, I don't want to lose more than this. Sell for me at 30.40. That's what your order is transmitted into the ears of your broker, into the platform. Once you click buy to the button of buy. So that means, and you place your stop loss at 30.40. Your order is transmitted, okay, buy this market for me at this price. In case if I am losing, I don't want to lose more than 20 pips. So the stop loss you place below your buy stop automatically transmits as what? As a set stop. Sell the market for me at 30.40. So you place the order. So the broker will broadcast the order. So the broker will broadcast this order to the general platform. Somebody is selling at so price. At so low price, 30.40. So the market maker will see that order as a good deal, very, very good deal at a lower price. So he doesn't have a choice rather than to do what? Rather than to move the market to this level to hunt the stops. It will hunt the stop by moving the market to this level and take out the stops, take out the order from you, and then he has manipulated the market and moved the market upward for a profit. Because he's going to sell at a higher price. He has bought from you at a lower price. So he's going to sell at a higher price to make profit. As he sells at a higher price here, he moved the market back into the equilibrium to balance is the portfolio so that he will have to create another portfolio, liquidity there. Move the market back to the equilibrium stage. That's exactly what happens. So the opposite is for the sell. If you are selling at the same time, if you are selling this, if you are selling Euro USD, if the sell order is this, if you are selling Euro USD at and you place your stop loss. If, for example, this is a sell order, okay, 360. You place your stop loss. Stop loss. You are selling at this level. Place your stop loss, right? You are selling at 30.40 to market maker. So your stop loss is above it. That's about 20 pips above your selling price. For example, you place 20 pips above this price level. So that means it is automatically transmitted in the ears of your broker, in the platform of your broker as what? As a buy stop order. Buy stop order. It will be transmitted at this. So in case you are telling this boss, you are telling the broker that if you are wrong, if the market goes above me from this level upward, please buy this market to close my to close my losses. To close my losses, buy this market at this level. That means you are buying at a higher price. You can see that you can see the ignorance of the retail traders. You buy high, sell low. You buy high, sell low. While the market makers do what they buy low, sell high. You can see the distance. So that is technique. So once they see this order as a good deal, you are selling at a higher price, right? You are selling at a higher price. So they will move the distance upward, right? They will move this until they are selling to you at a higher price. You move this upward, and what happens thereafter is manipulation. They move it downward because they must make profit. As they make profit from these 20 pips you've placed there, they move the market to downward because they are going to buy at a lower price to balance equilibrium. Right? So, what if you don't put stop loss at all? That is the most dangerous part of it. It's just like an open check. You are given an open check to the market maker. Take everything in my account. That's what it means. That was it. So that you must understand what you are doing before you do it. So that is the system of price manipulation. Why you cannot sue the broker? It's a legitimate way of manipulating the market. Yeah, to their own game. So that means you cannot sue them. You can't sue them. Off. So you can see, for example, here we have this price. We have the range here, the price range during Asian period. It ranges, then it comes down, moves in the opposite. It moves in the opposite. This is accumulation, distribution, accumulation, manipulation, and distribution. So the stop loss you place here, which transmits as a buy stop level, has been taken out by market maker. You see the hunt here. This is the hunt of your stops placed there below this level of support. So it has been taken out by market maker and move it upward, taking profit. They sell to you at a higher price. Sell to you at a higher price, then move the market back downward in order to come and buy at a lower price. That's balance. That balances the equilibrium. That balances the equilibrium. So up and down, up and down, up and down. So if you are buying, if they are buying in a buying market, this is what you get in a buying market. After the up and the down has been manipulated, price moves to the upside. For selling, this is what you get. This is the pattern. This is the pattern. This is the pattern. This is the pattern. For selling, that is what you get. So it happens nowadays. So let's get this right. Now, accumulation, we say price will range between 2 points, collecting orders at both sides. A lot of traders using retail concept will be buying and selling inside of this zone, anticipating a breakout. Then manipulation happens where you place your stops up to. So one thing you need to be aware of is that price movement or action is not random. It will always manipulate into the net distribution of profits into the upper or lower point of interest, which is what we call the demand and supply zone. So you will get that when we go into the proper interpretation. So distribution, the distribution phase is the profit taking a phase of the market. So this phase is where the price distributes, the market maker distribute all of the orders or liquidity or the asset they have gathered in during the accumulation phase. Yeah. So it also has a positive reaction with the orders from the POI being triggered. The price will then distribute it to a POI, that is pot of interest, to demand or supplies above or below the price range. So it is a pattern that will happen over and over and over, or that what price is doing. So if price starts to accumulate, you should automatically think that we are now seeing price accumulate, and it's likely to maintain the point of interest. Yeah. Manipulation happens every now and then. Every now and then. Every now and then. Price accumulates, manipulates, distributes. Price accumulates, manipulates, distributes. It happens every now and then. Every now and then. It's just the grammar, just like. So now, so today we're going to talk about AMD pattern. Is all about liquidity in the market and the trapping, which we call as a trapping zones of market makers. I repeat, AMD pattern is just simply about price manipulations of highs and low in the market. That is a concept we are treating, which involves where the knowledge of where market makers manipulate the market, which is the liquidity zones. The liquidity zones. So liquidity is everywhere in the market. The market requires liquidity to move. It is considered the gas as if it's a fuel that move price up and down. It's a fuel to price action. It's fuel price action. So they are resting orders and stop losses at all points I have marked on the chart. The market algorithms are put down to compare. So yes, liquidity is very good to be aware of, especially when it has been swept. Usually once it is swept, once the opposite direction happens. So that's where it goes. So you must study the pattern, you must master the pattern very well. So they either manipulate when this is where stops are being taken out. So that means if you are buying, if they want to buy, for example, if they want to buy, let me go to this place. So that means if they want to buy, if they are buying at the end of the day, throughout that day, this is what happens. If the market is going to buy, throughout that day. That is right. That means the market must be manipulated down. It opens, then triggered. Market will trigger all the stops that are placed below the support level or below the price range. Then fade the direction upward. So this place become what? It becomes a tiny wick. You fade the direction upward to a higher point, then move it, fade the high there, and close below the high. This one. So this place becomes the high of the market. This place becomes the upper wick. Why here this place becomes the lower wick? The lower wick, right? So market opens here, manipulates the lows of the range of the previous day. They hunt the low of the previous day, and then they move it in the opposite to the highest and the close. So this will become a daily a bullish candle. So that's how they if they are buying it. So if they are selling, it will be the opposite, right? Market opens here. For example, it opens here, right? It opens here. It opens here, then starts coming down to this level. Start coming down to this level, get to this lowest price, then they fade. Oh, sorry. They will first manipulate the highs of the range, right? So once they manipulate the high of the range, they move the market in the opposite. They move with, they fade the market and continue downward to the lowest point. As they get to the lower point again, they move it a bit to close here. So this becomes the open, this becomes the close, which now becomes the daily bearish candle, right? Like what you see here. And what you see here. This is a 15-minute chart. 15 minutes. A 15-minute chart. It's gonna be daily charts. The way you see it. So this is a bullish candle. See it. This is a bullish candle. So price moves down, manipulates downward, and starts moving upward. It opens here, manipulate down, and close above. For bearish, it opens here, move up a bit, then close below it. So that's how it is every now and then. Market does not move in a straight line. So there will be manipulation of the highs and the lows of the market, then before the market will fade to the opposite direction. That's exactly what happens. So let's get back to that manual to see the pattern. This is the pattern we follow. Identify where liquidity pools are being found, where the market makers look up to trade, to manipulate. First pattern we have is equal highs, which is known as the double tops. The people that are trading double tops and double bottoms, they manipulate the double top and the double bottoms They manipulate the swing highs and the swing lows, manipulate the trend line. The trend line, which is the breakout of channel traders. People who trade channels and place their stops above the highs of the channel. They manipulate it. People who play that for buying. People place their stop below the channel lows, but it's manipulated and move this into the opposite to buy. Yeah, they manipulate the equal lows, break it down, and so move this in the opposite side. See what happens here. This is the previous day. For Friday, this is Monday. Monday took out the high of Friday. Then what happens? What do you see? This is accumulation, manipulation, distribution. This is accumulation of this previous low here. This is accumulation range, accumulation phase, right? Then manipulation. The low of that range was manipulated and price move in the opposite, distribution happens in the opposite. That's what happens every now and then in the market. See it? Equal highs taken out, equal highs taken out with the double top. People who traded this double top, believing that, okay, I'm selling. Once the price has got to the double top now, they sell immediately here and they place their stop loss here. So the market maker will move the price upward to take out the stops, move the market downward. So if you are not careful, if you sell early, if you have sold early here, your stop will be taken, got frustrated. The market, in the opposite. So this is what happens. Every go to charts, you see it like that. Equal highs taken out, market moves in the opposite. Equal lows taken out here, market moves upward and down. At every point in time, at every highs and lows of the market, once the high of the equal highs, equal lows of the lows or the swing high or swing low taken out, price will move in the opposite. This is a trend line. People who traded this, people who were trading, they were selling in the channel, right? This downward channel, placing their stops above here, placing their stop above here, placing their stop at price moves. You can see the sweep of this high and it moves in the opposite, but manipulated and moves in the opposite. See, and move in the opposite. It happens in all the financial markets. This is pounds AUD, swing high taken out. It's 218 pips. 218 pips. 218 pips there. So we must, when we go to part 2, we talk about this inducement of a thing. What makes market maker to trigger the highs and the lows? What fuel their action? What triggered, what pushed them? Because not all the highs and lows are potential to trade. Because something you want it to give big profit, but it doesn't end up that way. What causes it? So there are reasons. This is what we call inducement. What we call inducement. So let's go now proper to the trade and see how this happens live. How it happens live. So, for example, we have this. See, so this is the pattern, right? Accumulation, manipulation, distribution happens, but you must know the entry point. The entry point is when the market try to test the manipulation area. That's where you don't sell here. This is the retail traders philosophy. They want to sell here, and meanwhile, as they sold here and the stop loss were placed here, the market maker will still go up and take out their stops and not the stops and market down. Some of them they place stop here, place stop here, place stop here, place stop here. They want all the stop losses and finally move it down. So you wait for a retest. You usually wait for a retest. Waiting is a great virtue in trading. You wait for a retest. See here, this is the recent this in which I gave on my I gave this on my group. Yeah, I shall give. Yeah, I gave this on my group as a buy order in the midnight, today midnight. Today midnight. Yeah, I told them to buy, to sell gold. Having gotten this, so let me share it. See it. So I gave them this. I gave them this. See, so the manipulation happens here. It's on the 7th of March. 7th of March, which was yesterday. So today, yesterday, I gave them yesterday. It was yesterday midnight, around at exactly 12 a.m. of 8th of February. Oh, sorry, 8th of March. So as I saw this, I was taken out. Get this, and this BMS. So it meets our trading rules, trading formulas for trading. The formula we use for trading AMD pattern. So I got this here. I got this move here. I was like, okay, today is Monday. Okay, sorry. We are in Tuesday, right? And price has been overpriced on Friday. So that means Friday is end of the week. What we call that the end of the week AMD reversal. We have midweek AMD reversal. So I got this and I told them to sell gold for scalping profits, gold moving, market start moving. You can see that start moving. Huge profits, huge profit. So which already materializing into this which profit there. See, can imagine much profit has been taken out there. It has moved almost about there. It has moved almost about there. More than 100 pips. More than 100 pips. More than 100 pips. You can see it here. See, almost about 187 pips. 187 pips. But how do we get here? How do we get it? How do you trade it? How does this work out? For you that still doubting if this pattern of a thing, the pattern of a thing works. So powerful. I'm telling you, so powerful. See, so now this is the setup, right? This is the setup. So we're expecting price. This is the accumulation area. right? The manipulation of this equal highs. This equal high be taken out. Liquidity has been grabbed there. And price move now what to take out this liquidity. There's liquidity here. You know, this is a V shape. Which is a V shape like this, like this. It was grabbed out. It was grabbed out. So people that play that stop loss here have taken out, grab this, and we expect price to start moving in the opposite. See it? Price start moving the opposite. So after grabbing at the stop losses, opposite. After grabbing at the price moving the opposite, exactly that is what price is. Grabbing up of this equal lows or low here moves in the opposite. You see that? So that is what happens now and then. So that is, you can see it, my price moves. So we are expecting price to push into this place so that we can sell. So this gap must, as price takers say, they must move it upward to sell for profit and back to equilibrium. So here we now say price has been creating. Oh, sorry, that's not what I'm talking. There's a space being left here that must be filled up. Being left here that must be filled up. See it? So price must fill this gap. Must fill this gap. So they will take out this high, move up. This is what we call an inducement. So this becomes the supply zone, which price will move into, distribute the profit to the supply zone, and after selling to retail trader here at a higher price, they move the price now. So this is where you are coming to sell. Which your sell here and not here, not here, not here. Come on, if you have sold here, you put your stop loss here has been grabbed out. Yeah, so you must wait for the right time to sell. You must wait for the right time to sell. You must wait for the right time to sell. So it was grabbed. Grab it. So it will push them into this. That's why we call this place an inducement. This place, what we call an inducement. Come to that maybe part 2 of this. Price move to that place. You see, you get to the DC. So meanwhile, all these lows are coming to be grabbed to this. This place has created another space. That space has been created here. Which we call the liquidity void. So price must fill it. So whenever a gap is created in the market, it must be filled. So in order to balance equilibrium, they must balance equilibrium in order to create another liquidity to take market for up. So get to understand that. So whenever the price moves out of balance or out of the equilibrium, it creates an imbalance. It creates a particular gap. So they must come back and fill that gap, then move the market again. Yeah. So now, how do you enter? You say your DC here. Then that means you go to take as you create your supply zone here. This is your supply zone. Your order is your sell limit is set. Sell limit is set. So my target will be here. Or the first target will be here, which is at 8 RR. See it? So, and price push into this place. As long as price has come into this zone, your orders is triggered. Your sell order is triggered. I imagine that sell order is triggered here. This place here, trigger out your sell order. Price push into this place, so this becomes your stop loss, and it's because we are using this formula. This is our formula once their formula is being established, so formula is being established, which is SH plus MS. We look for this to be established before we. So this forms our rule-based strategy, confirmation entry. Confirmation entry. We wait for to confirm the entry before you enter. So then this is what from the formula you use to confirm the entry. Here's the formula. See it? So where's our SH? Your stop point. Your stop point is here. The manipulation is after accumulation. Comes into manipulation, which is the stop point. Then price moves down to break a particular market structure, a structural, because the previous trend was up, right? This is the higher price was moving higher. Price was moving in this manner, higher high to create higher low, created, and this is the higher low, higher high taking out. Higher low. So the price moves to break below the higher low. This becomes our BMS. So what we call as a change of character. So from bullish into bearish, but we must confirm in order to sell. So in order to sell, we must confirm. This becomes our confirmation entry. It becomes our confirmation entry. Yeah, it's the formula. So you can see that this is SH, BMS, and we wait for price to return back into this block, to this liquidity block, this of the supply zone. So we got our engulfing here, You mark out the engulfing, and that is your supply zone. And price must return back into this zone. This price will distribute profit back into this zone. As this low was taken out, it will distribute profit into this zone. As you get to this zone, this is a trapping zone. Call it a point of interest. Yeah. So all that's going in place here. So market makers start distributing price downward. As they took at this, distribute. Start distributing. This is if you are selling, you sell with them here. Right from here, you sell with them from here. Right? Sell at the higher price. You are coming down with them to buy at the lower price. Can imagine price hit your decision. Yeah, so that is the present situation right now on the 8th of March. Imagine the profits you're getting almost about times. Wow, times 6. Times 6. Times 6. Your stop loss is just 29 pips. 29 pips. Once this is you close this gap. Close the gap. Close the gap there. It's about 26. That's huge. That is huge. That's huge. So that's how we traded this. That's how we traded this. In our advanced course, we talk about so that's how we traded. In our advanced one, we talk about how do you refine your order that you don't use more than you use a very, very low risk, to get a higher reward in advance. That's an advanced course. Yes, I want you all to, if you are watching this right now, yeah, I want you to subscribe so that we can put together this. So this is the course. This is the mentorship program. Yeah, the mentorship program. Just plug into this and let's see what happens. Start to make payment. just connect with me. Give me a kind of charts. Give me just hit me on my Telegram and stuff. Hit me up on my Telegram. I think so let's talk. Or WhatsApp. If you get your WhatsApp. This is my WhatsApp number. Just WhatsApp. And I have my trading group too. My trading group, which you can join. My trading group. This is the free class. But for mentorship class, it's not free. It's not free. Where we teach advanced method. How do you refine your trade? How do you mark the zones so that you get a good entry point? How do you mark the zones? How do you take your profits? How do you set the profit? How do you set the stop loss? And how do you manage your trade? Then not all zones are tradable. In this course, you get to know about liquidity very well, manipulation. Then how do you refine your zone, your supply and demand zone to a very low size? And how do you select those zones that are potentially tradable? Yeah, we talk about how do you build your trading mindset, a winning mindset, then risk management. Yeah, risk management. So just hit me on my Telegram and talk about that. God bless you.